as you learn options, it's important, in my opinion, to have um, um, two different type of accounts. You can have an account that is your more aggressive speculative type of account that you absolutely want to make money on, but you're trying to make these outsized gains, but you still don't want to lose your money. No one wants to lose any monies. But you should also have what, like a Roth IRA account, or a traditional IRA account or something like such as that. I prefer the Roth because you don't have to pay taxes after your gains and so forth later on when you start to kind of, do distributions and so forth. But I I believe that you can have a safeguard strategy as well in a margin account, as long as it's just two different accounts. So you can have, your more speculative type or aggressive type of trading, and then your safeguard type of trading. So we call it the safeguard strategy because it is like a buy and hold concept, but has the ability to make more over time because you're always lowering your cost basis with the type of trades that you execute. And if you do it on stock indexes or things that have almost a zero, if not a 0% chance of going to zero, you can enhance or better even make it even more safe. So if the overall market, let's say the overall market is the S&P 500, this is the ES here. Is we also look at that as the SPX, or the SPY, right? The S&P 500. If you are following that, if you're doing a safeguard strategy on that, and the S&P 500, for example, last year was down 20% basically, or if you are constantly doing strategy within that S&P 500, that's always lowering your cost basis. So most likely you should have did a significantly better than being down 20% last year because you were always lowering your cost basis. Now, I think you can do that in the SPY now, or you can do it in indexes that are similar to the SPY with with the safety in mind, right? So, for example purposes, let's say you were looking at the SDY, right? Let's go over here really quickly. SDY is the S&P 500 ETF for dividend stocks. So all the stocks in the S&P 500, not all, because they all don't pay a dividend, but all the ones that pay a dividend, this is an ETF for it. And if you look at this chart compared to the SPY, now look how this one has been up and down, but not down significantly at the end of this last 12-month period. If you look at the SPY, right? So it's been mostly down. The trend has been mostly down for the last 12 months, right? But this is the same thing, super safe as SDY. And if you're using a safeguard strategy, you're trying to make money every 30 to 35 days, give or take, right? Sometimes it's going to be a little less than that. Sometimes it's going to be a little more than that. But you're trying to supplement your income on a monthly basis using a not only safe strategies, but safe underlinings. So stock indexes for the most part. Obviously, you can have a core position in Apple, something like that that you feel like you have a good understanding of and you love it and you want to trade it. But Apple has a chance to go to zero. It's darn near a 0% chance because so Apple is a not a good example, but stocks, individual companies have a higher chance to go out of business than a than an index, right? Or when things go bad, they're usually going to go bad more than the stock index. So you want to look at things that if it's going to be down, it's not going to be down as much as usually the stocks within it, and you can lower the cost basis and outperform these as well. But the strategies I'm talking about very quickly is that this is the SDY. And let's just say you wanted to do something again, once again, 30 to the 35 days out. If we went to this 35 days, and let's just say that we were okay with taking ownership of these shares, but instead of buying at the money right now that's trading at $129.59, we decide we're going to sell at this 129 strike, for example purposes, This is the naked put. Some people call this the wheel strategy. We call it the safeguard strategy because we add two more strategies to it. So in the wheel strategy, you usually start off by selling a naked put. This is a naked put here. You can collect about 182 if you can get filled at the mid. Your call spaces will be 127 basically. It's currently trading a little over 129. So this is how you can lower your call spaces and be okay with taking ownership of something, but you're just getting it at a discount than the going rate. And that's always good, right? It's always cool to get something at a discount. So you're selling this naked put. A naked put is going to give you high probability. It's going to be more than a 50-50 shot, or it should be more than a 50-50 shot. As you can see here, we're selling this basically at the money. It's giving us a 66% chance of winning. And you can decide to sell at the money. You can decide to sell a little further away. You can have an arbitrary number that you want to collect, $100 or $50 or whatever the case may be. But you can see this is something that's mirroring the S&P 500, mirroring the market, but you're getting it at a lower cost basis. If you had to take ownership of these shares, let's just say right now it's 35 days out, you had an ownership of the shares, you had 100 shares, and you wanted to do a covered call. Well, you can do a covered call. That's when you have 100 shares and you decide to rent out your shares or sell a call against your shares. It's called covered because you have the shares. If you sell a naked call, the person who sells a call has the obligation to provide shares to the person who buys the call. So if you already have the shares, then that means you're covered. If you don't have the shares, then that means you're naked. But in this case, that's if you had the shares and you wanted to sell something at the money, someone's going to pay you $226 to sell them the call at the 130. And if it goes up and expires above the 130, you can win. You can make 265. But if it goes down, you still have some cushion, some wiggle room for it to go down as much as around $127, and you'll still be able to at least break even around there. Okay, so you have some cushion for the stock to go down some, and then you continue to sell calls against it. So with the wheel strategy, it's just the naked put and the call, and you keep repeating the process. The next strategy that we at the Dorian Way throw into our safeguard is that after you've done the naked selling of the naked put or selling a covered call, you can also do what we call is a collar strategy. And it's bullish. All these strategies we're going to talk about, all these four strategies are bullish. A collar strategy is when you sell a covered call, but you take some of the monies from the covered call and you buy a put to protect yourself. And what we like to do is buy a put 5 to 20% down to protect yourself from the stock falling a lot. So if you're doing this type of strategy last year, you could protect yourself significantly from the stock falling too much, right? So in this case, it's you're collecting 229. So I want to buy a put for no more than 229, but I can buy a put for, like, for example, here at this 127 strike with the next 35 days to go. So what it means is that I can't lose anymore if this SDY, this ETF goes below 127 in the next 35 days. I can't lose anymore once it goes below that. Okay, so you're kind of protecting yourself to the downside, but you want it to go up. As you see right here, these deltas are long. It's still bullish. You want it to go up. The market's just closed. We'll discuss the markets here in a second. You want it to go up because this collar strategy, even though it has a really bearish element to it, it's still bullish. You want it to go up as these deltas indicated. And if it goes up, your max you can win is 140 here, but the max you can lose within this time frame, this 35 days, is 160. So that's why you would use this type of strategy, just to say, okay, I want to hold this, collect the dividend, whatever case may be. I love this stock, but I'm really, really nervous over the next month or so that this could go down more. I want to protect myself. I can sleep a little better at night. So that's the collar strategy. The next and last one is when you are really kind of bullish on something. That's maybe it's going down, you were protecting yourself with a collar or something like that. Or you just want to start off and say, I want to do something that's going to give me a little bit more juice to the upside, but I'm lowering my cost basis. So what we call it is the Bionic Bull. This strategy was created by Ernie. He's the inventor of this, or at least the name of it. And he was the inventor of this strategy for us as the Dorian Way, and we love it, and we threw it into our safeguard because it could be super safe if you are okay with taking ownership, but it can give you a pretty much unlimited upside within the time frame. So let's just say I was bullish on this and I wanted to sell this I wanted to sell this 129 and buy this 131. Well, this is going to give me 86. It's going to give me 86 deltas, and it's going to be for a small credit. It's not a large credit, but it's a credit nonetheless. If I decide that I wanted to do something a little bit more aggressive and sell this 130 strike in the put is in the money, well, I'm going to get more deltas. I'm going to get almost 100 deltas. This is almost having 100 shares because each share equals one delta. If I have 100 shares, I have 100 deltas. This is 94 deltas for a credit. So 94 shares basically for a credit of 42 cents. If it goes up, you're going to be able to benefit from all the upside. But obviously, if it goes down, you're gonna have to take ownership of the shares where the cost base is about 129.58, which is basically exactly where it's trading at now. Okay, but you're controlling the 100 shares for a lot cheaper than just buying the shares at this point. But that's fine. But what we like to do most of the time is set up the bionic bull in a way that the probability is still good for you, right? So if you did something like this for example purposes, you can increase the probability, keep your delta still fairly high. If you were doing it in something like this OI, this OHI, this is that REIT we were talking about 35 days ago. I'm going to clear this and then just say I sold this one at this is going to line up better. If I sold this one at the 28 strike and bought this 29 call, it's going to give me almost 80 deltas. As you can see here, my probability is just under 60% of winning on this trade. My cost basis is 27.20, which is almost $1 less or 90 cents less than what it's currently trading at. So that's pretty awesome, right? This is how the Bionic Bull allows you to have unlimited upside within the time frame. So you can see here that if it goes down, you can still win 50, 58, 60% of the time. If it goes up, you're going to win 100% of the time, and you have unlimited ability to the upside if it's going to shoot up. So this is kind of things that if you had like an Apple stock that's been going down a lot recently and you felt like, okay, it's way oversold and I love Apple, this is the kind of thing you can do on Apple Bionic Bull within the next 35 days. And if you had to take ownership because Apple drops, if you're okay with that, then great, because you don't think Apple's going to zero, and most of us do not think that's going to be the case. You can get the dividend that it pays and you can keep selling calls against it. So you can do it in stock indexes, which is super conservative. You can do it in companies that are really awesome that you do not have to worry about, oh, it's almost a 0% chance they're going out of business. Okay, so the Dorian Way, the strategies are the naked put, the covered call, the collar, and the Bionic Bull. That was the 4 different strategies that we talk about at the Safeguard. If you want to learn some more about it, jump into our video library. We do discuss this in more detail, providing more examples and so forth. But this is what I wanted to talk about for just a quick little teaching class this afternoon.